Aruba is making a bold play for investment, and it's happening right now. As of January 1, 2026, the government has rolled out a new set of tax incentives designed to reshape two key urban centers, Oranjestad and San Nicolas, while also giving qualifying startups a major financial runway in their first years of operation. Here's why this matters. Aruba is targeting a familiar problem across many tourism-driven economies: aging commercial buildings, underused downtown corridors, and the need to diversify beyond traditional travel revenue. The new policies aim to pull capital into redevelopment projects, accelerate construction and renovation activity, and spark a new wave of entrepreneurship that creates year-round jobs. The first headline measure is an exempt company framework for approved redevelopment projects in designated parts of Oranjestad and San Nicolas. If a project qualifies, the reward is substantial: a profit tax exemption and dividend withholding tax exemption for up to 10 years, running through 2035. On top of that, there is temporary relief for transaction-related costs. Certain transfer and turnover taxes are waived for a limited window in 2026 and 2027, lowering the upfront friction that often slows redevelopment deals. But this isn't a blank check. Aruba is attaching strict conditions to prevent abuse and ensure real economic impact. Projects must be focused on redevelopment activities within the designated zones, and investors must meet meaningful thresholds. Minimum investment requirements are set at 500,000 Aruban florins, or at least 50% of the property's ground value, whichever is higher. And if the requirements aren't met, the system includes clawbacks, meaning the tax advantages can be lost retroactively for projects that don't fit perfectly into the full exemption regime. Aruba is also offering a second track, flexible depreciation, that can allow deductions of up to 500,000 florins in renovation and redevelopment costs across the same longer-term period, giving investors an alternate way to improve project economics. The second major pillar is startup support, targeted at 6 sectors Aruba wants to grow: tourism, the knowledge economy, logistics, agriculture, the circular economy, and creative industries. Qualifying new companies can receive an income tax exemption on profits up to 50,000 florins per year for their first 5 financial years. The package also includes a stronger investment deduction, 20% on qualifying business assets above a set threshold, and additional deductions tied to new business loans, up to an annual cap. And again, the fine print is the point. Aruba is prioritizing substance. Companies must demonstrate real operations on the island, maintain appropriate staffing levels as revenue grows, reinvest a portion of turnover back into the business, and avoid dividend distributions during the incentive period, so the benefit fuels growth, not payouts. The takeaway is clear: Aruba is signaling that it wants investors and founders who are ready to build physically in its city centers and economically in its next generation of industries. And with the incentives now active, the rush is on for developers, entrepreneurs, and offshore professionals to structure plans correctly and move before key compliance deadlines close the window on these advantages.